Hello and welcome back to The Long Short, the podcast that delves deep into global investing trends with leading experts in the field. I'm your host, Tom Kehoe.
And I'm Drew Nicol.
Well, today we're exploring the world of emerging market debt, an asset class rich in opportunity but often misunderstood.
Emerging market debt, or EMD, offers investors a compelling yield premium, but it also comes with its fair share of volatility. The key question is, how do you balance the potential for high returns while managing downside risk?
Well, to help us unpack this and much more, we are thrilled to welcome Polina Kurdyavko, Head of BlueBay Emerging Markets and BlueBay Senior Portfolio Manager at RBC BlueBay Asset Management. With years of experience navigating the complexities around EM investing, Polina brings a wealth of insight into how to take a truly unconstrained approach to these markets.
Polina, welcome to The Long Short.
Thank you, Drew. It's a pleasure to be here.
Would you mind starting by just giving us an overview of BlueBay Asset Management and your relationship to RBC, and then specifically your role in shaping emerging manager fixed income strategies?
Sure. So BlueBay started as a fixed income boutique over 25 years ago, focused on absolute return strategies within emerging markets after Asian financial crisis and European credit with the formation of the euro. RBC acquired BlueBay now 15 years ago to use the firm as a content provider for this global fixed income and equity strategies. So today, BlueBay, as part of RBC, manages just over 130 billion in assets across global fixed income platform, but has about $500 billion in assets if we look at both equity and fixed income capabilities, both internationally and in Canada. When it comes to my role in the firm and the history, if you will, of emerging market fixed income, I joined the firm over 20 years ago to build emerging market credit platform. And I think that it's important to note that while emerging market fixed income asset class is fastly growing, the familiarity with the asset class and the dedicated investor base is actually relatively small. So what we have focused on is helping innovate within this asset class and develop this asset class. If I look at the relative return space, we've developed three major indices, both with Bank of America, Merrill Lynch, and JP Morgan, that focus on emerging market fixed income. If I look at the products that we generate and produced in some of the products, we're amongst the very few, if not the only one provider. For example, we develop products and strategies that run locked up vehicles that invest in emerging market loans. We also look at strategies that look at local corporates vehicles, for example. And I think behind it is really a simple narrative. Firstly, every time you look into the sub-asset class that is at the early stage of its development, you get more opportunity to generate alpha. Secondly, if you look at fixed income in emerging markets, and this is a $30 trillion asset class across four big sub-asset classes, over 80 countries, and over 2,000 issuers. If you want to really understand how to invest in emerging markets, you've got to have your fingers in every single pie. Because at the end of the day, it's the mosaic theory, due diligence, that really underpins successful investing in EM fixed income.
Yeah, Polina, as you touched on it, emerging markets and those who would invest in emerging markets will have opportunities and risks associated with that. So from your perspective then, what are the biggest factors shaping EM debt today?
So if we look at emerging market fixed income, I think that from a fund perspective, it's important to say that historically, or at least over the last decade, investors have had more challenging experience investing in local currency strategies and had better risk reward in hard currency strategies. So it's not surprising that on a relative basis, we've seen more flows coming into hard currency strategies. I also think this is an asset class which continuously delivers higher yields than its similar rated peers in developed market fixed income, but also has higher volatility. And really, the question that investors have struggled with and tried to resolve is how do you capture that upside and that additional carry, but actually manage it in a vol control environment?
An emerging markets debt offers quite a compelling yield premium, but of course that comes with periods of relatively high volatility. So how can investors strike the right balance between capturing that upside that you mentioned while also managing that downside risk in an unconstrained strategy?
Sure. So I think that if you look at emerging market investing, you can take a total return approach or you can take an absolute return approach, and you can use different tools to reduce the volatility. Let's start with the total return approach. These are the strategies which would be in the UCITS format that have daily liquidity. But for us, it's important to understand that when you select best ideas in emerging market fixed income, that 30 trillion pie, you're actually combining asset classes with very different liquidity and volatility regime. And away from your bottom-up selection of those ideas, you have to understand the technicals of these asset classes to then construct a strategy that actually reduces volatility while focusing on your best ideas. And EM unconstrained is the best example of that. Let's picture sub-asset classes that fall into that product. You have hard currency credit, sovereign and corporates. You have local currency credit, sovereign and corporates. And within local currency, you can have a rates component and FX component of the trade. So for us, when we think about the construction of the portfolio, we take different time horizons and different trading patterns to each of those segments. For example, hard currency, it's an asset class which is mostly dollar denominated, has relatively high transaction costs compared to FX, for example. So we take longer term high time horizon, 12 to 18 months. And this is a relatively core, stable part of our book. FX, on the contrary, has the lowest transaction costs, the highest liquidity, and the highest volatility. So what we use FX for is not only our ideas from a bottom-up perspective, or top-down for that matter, we actually use it as a hedge to hedge the risk that we're running on the long side of the book and to reduce the volatility. That's why historically we were able to achieve higher absolute return and relative return than the beta and yet lower volatility.
Polina, last week you published on your website a white paper titled In Praise of Unconstrained Investing. Can you offer our listeners just a quick insight into what we mean by that, or what you mean by that rather, in terms of investing in EM debt, and what does that mean in practice? And the second question would be, how does it differ from traditional benchmark strategies, and the advantages that offers investors?
Sure. Well, I'd start by saying that investors had different experience when investing in hard currency strategies versus local currency. And as I mentioned, actually, hard currency strategy delivered relatively consistent risk reward. In fact, within hard currency, emerging market corporates had the best risk reward historically on the index level, compared to, for example, not only EM sovereign, but also US high yield and US investment grade fixed income. But when it comes to locals investing, managers and investors have had more difficult experience. And therefore, we've seen most not allocating to the local part of the portfolio over the last few years. Now, we think it's a mistake. We think, because let's not forget, out of the $30 trillion asset class, 85% is in local currency. Not investing in that might not be the best way to reduce your volatility, but investing it in an unconstrained way, in our view, is a much better approach. So let's start by saying why local index might not be the best index to invest. Because it's highly concentrated index of just over a dozen of countries that actually doesn't reflect the universe. So those who would be managed and have tight rules against that index are likely to have a worse experience than the investors that have more of an unconstrained approach. Also, if you think about the index, it to some degree forces you to be always invested. But in local currency, especially in its FX component, sometimes being not invested at all or actually having a negative exposure to EMFX could also be beneficial. And so we feel by having that flexibility, you have the best of both worlds. Let's look at this year. Who would have thought that the best performing asset class year to date in global fixed income is emerging market local currency debt? Having had Donald Trump leading the way on the tariffs and the taxes and all the uncertainties that we have, yet we have a very strong performance in this asset class with EMFX, again, outperforming EM rates as well. So you want to have that flexibility to have exposure to this asset class, but you want to make sure you manage the downside risk. That's why we feel for those investors who are a bit less comfortable having a benchmark approach and just going into local only strategy, there is a better way to diversify your risks, but still stay invested in the asset class by using an unconstrained approach.
You mentioned Donald Trump's tariffs there, and this might be a useful opportunity to just take a step back and put everything you've said there into the context of now, because given today's geopolitical and macroeconomic landscape, there are all sorts of themes that will be underpinning all this decision making that you're making. So in a broad sense, given all that's going on, what are the key themes that you're tracking most closely, and how do they influence your decision making?
Sure. Look, I think that it's often helpful to step back and think about the starting point for EMFX, which is EM fixed income, which is always fundamentals, right? So for us, there are three themes that we monitor for this year. Firstly, fundamentals. The highest correlation of spreads is with expected default rate in fixed income, EM or DM. Therefore, we need to start from the expectations on default rate. And for us, having had a double-digit default cycle in the sovereign space and elevated default cycle in the corporates over the last 5 years, on the index level, we feel that this year, the default for sovereign debt with a high yield rating will be very close to zero. And the default for corporate debt will be below its historical average of 3.5% and also below US high yield and European high yield default rates. Why does it matter? Because it defines the direction of spreads in emerging market fixed income. Now, with that said, I actually think that we have a number of countries, the vulnerable countries, that could have a default over the next, 12 to 24 months. So we're not saying that the default-free environment is here to stay to some degree. We feel that we're in the short term, we're unlikely to see spikes in defaults. Now, how do you want to play that theme? I think from strategies with total return bias, you want to position in the countries where the spreads have adjusted much wider, or in fact the yields have been much wider because those countries have recently restructured. And that's often one of the best ways to diversify your portfolio, because having restructured, countries go on the IMF program and have very little debt to repay while they are on the IMF program. So you're getting elevated yields, but actually relatively low default risk. Now, from an absolute return perspective, and let's not forget that, if you think about absolute return in emerging markets, and I would say in any alternative products, there are two ways to take advantage of absolute return strategies. You either take advantage using directional strategy, but buying an asset in a discount, whether it's distressed investing or it's illiquid investment, where you're being paid for spread pickup for illiquidity, or you are investing in the asset class where you generate returns from volatility, not from the direction of travel. And therefore, for us, in our absolute return strategies, we think it's a fantastic opportunity to position for 1 to 2 year time horizon, when we know there are a number of countries that are likely to be vulnerable and possibly will go through defaults. So for those countries, we can position already from a short side, anticipating these defaults to materialize. And on the other hand, we can fund them from positioning in the countries that have just recently exited the default. And as I mentioned, give you double-digit yield. So that's the first theme on the sovereign side. On the corporate side, the best way to play this theme is, again, identify those credits that we think are more vulnerable. And in particular for us, it's the commodity space, in particular oil and gas space, which can be a bit more vulnerable given how much uncertainty there is on oil prices. So we identify individual companies that are more sensitive to low oil price and cannot sustain the current cap structure. On the other side, we're looking at the either issuers that actually recently restructured their debt or issuers which have been penalized given historical default rate. For example, you look at Asian high yield market, it has been decimated because of the Chinese real estate. But actually you have some credits that today trade at 30 cents on the dollar that actually are likely to pay you back. So that's the first theme. The second theme for us is divergent policy mix in local currency. We've had a lost decade for emerging market local currency debt. As I mentioned, even once I was doing an interview with a journalist and I started talking about local currency, he said, please, let's not talk about local currency because I'll lose my job if I write once again that there are opportunities in local currency. And that's exactly the time when you want to look at local currency, because it's not a positioned asset class. It's an asset class with a lot of skeptics. But as I mentioned earlier, why did so far emerging market local currency asset class performed really well this year? Because in addition to good technicals, central banks in emerging markets have had a divergent policy mix from developed market colleagues and actually still have very high real rates, while the currencies have really devalued over 50% on the cumulative basis if you look at the last decade, and in some cases are very attractive on a real effective exchange rate. Now, we know currencies are like seatbelts when accidents happen. I can put a fundamental valuation on the currency, but ultimately, if tomorrow we have a banking crisis in the country, this currency will be going first if it's a free-floating regime. With that said, I think that there's a lot of interesting real-value opportunities within that narrative to express in, for example, a strategy like an unconstrained strategy. And last theme would be Donald Trump. The tariffs, the taxes, and ultimately what really matters for us is the implication on inflation and core rates. Now here, how can I not mention geopolitics to throw in that mix? So what is the best way for us to play it? Well, several levels here. Let's start with tariffs. We know we're, coming up to a big moment when we're likely to be announced the tariffs or policy on the tariffs either sooner rather than later. And some countries might be negatively affected than others. With that said, we think that in some cases it's a lot more priced in than in others. For example, Mexico and Colombia are trading at all-time wide in credit because of the fear of tariffs. But some other countries actually are not reflecting that in their spreads. So we like to put a relative value book, if you will, on the headline risk because we think a lot of the risk on the tariffs in certain countries is already priced in, and in others, it's not enough. With that said, if we look at geopolitics, again, very similar way to play geopolitics. If you could have Donald Trump having a global pacifier effect. We feel that the best way to play it actually in the latter case is through distressed debt, because should we see a more positive outcome of geopolitical risk, countries like Lebanon might actually have a chance to proceed with their restructurings, and they trade at 18 cents on the dollar. So each individual theme, whether it's geopolitical, whether it's tariff-led, whether it's default cycle-led, can be expressed in the absolute return strategies in emerging market fixed income that take advantage of volatility. And that's why if I look at the last decade, we've had double-digit net returns consistently without a single negative year, even though the asset class has returned zero, very close to zero on the annualized return basis through the same period.
So that's very insightful, Polina. So how about we just get a little bit behind some of the process behind how you do all of this? You've gone through all the themes, you've looked at the various approaches that you and your fund will examine. What does the process look like from market analysis to execution? You talk about mosaic theory and bringing that into your research, particularly when you're looking at a new emerging market opportunity. How do you go about balancing the various research that you might do on the ground and any data-driven insights that you would derive?
Sure. So I'd start by saying that if we look at EM investing, for us, from day one, we felt that we cannot invest without direct engagement with issuers, both corporates and sovereign. And that means collectively as a team, and we're almost a 30-member strong team, we spent about 70% of our time on the ground in emerging markets. And majority of our trips are self-organized. Now, it's also equally important to apply the mosaic approach that I mentioned, because the correlation between the sovereign risk, corporate risk, local currency funding and access to funding is very high. So we feel it's very difficult to make a correct assessment on the best risk reward in the country unless you really understand how all of those segments interact. But while the research on the ground is very important, I often say to my team members before they travel on the ground, please start with reading a 200-year history of this country, because the policy makers can tell you a very compelling narrative. But as Argentina proves once again, we need to understand the structural issues that go way beyond the current policy mix in order to really understand the future and the outlook on a particular story, be it sovereign or corporate.
That's a perfect segue, actually, to my next question. You mentioned having to read a 200-year history and really understanding why countries are in the situation they might be in from a credit point of view, which tees me up perfectly, because I wanted to ask you about lessons you've learned from previous market cycles in the fixed income emerging market space, and to what extent you are able to glean facts from the past in order to project into the future.
Look, I think that the main takeaway for me is that whether we talk about EM investing or DM investing, one cannot take any information for granted. You really have to have that curious mindset and not be shy to ask questions. Most things, in fact, all of the things that we do are not rocket science. And if someone tells you a narrative and you don't understand it, it means this narrative doesn't hold up. So for me, the rule of thumb, if I can explain it to my 10-year-old son, chances are I understand it relatively well enough. And that's what I'd like to hear from my team members as well. I think the other point that I would say in terms of lessons learned, when I started investing in the just after '98 financial crisis in Russia. I was quite encouraged by the fact that this is a growing asset class. I thought, oh, well, today is only several percentage points as a percentage of allocation of fixed income investors. In 20, 30 years, it will be a much larger percentage. But actually, here am I today. The asset class has grown exponentially, but it's still a single digit in terms of percentage allocation in investor portfolios. And what it does is it creates opportunities for alpha, for absolute return strategies, because it's probably still one of the most under-researched asset classes with the most disparate pool of players compared to other fixed income or equity products.
Polina, talking about emerging markets and opportunities that you see, particularly in EM debt, liquidity risk, I would imagine, would be a big issue looking at emerging markets. So how do you then go about managing the various challenges that you would see in that regard, and any mechanisms that you would use then to ensure that you get efficient market access?
I think liquidity is one of those misconceptions about the asset class. Because firstly, liquidity is a derivative of the size of the asset class and the size of the issuer. If you have over $2 trillion in sovereign debt, but it's only spread across 80 countries, the debt per issuer is going to be quite large, the debt stock. And that's what creates liquidity. Therefore, even if some investments trading at 20 cents on the dollar, you can still trade them in 200, 300 million clips if they have 20 billion of bonds outstanding, which you can't do in other fixed income, be it developed market credit or other forms of credit. So I think that's where the misconception is about liquidity, or misperception rather. I think the second point I would make is that when we talk about liquidity in the corporate credit, it also is driven by the size of the issue, which in this case is smaller than the sovereign, but also by the type of buyers. If you think about it, the second largest group of buyers of dollar-denominated corporate issuers are local players, because for them it's a risk-off trade. And for investors like us, it's a risk-on trade, which means that when you have crises, you have two-way flow between those two pools of investors, and that's what creates liquidity. So yes, I would say that in general, credit is less liquid than FX, for example, and therefore very few CTAs use EM corporate credit or sovereign credit, given its liquidity. But I think within the credit world, actually emerging markets is one of the most liquid credit products.
You've talked about how you analyze these opportunities and are looking at fundamentals and the history and all sorts. But something you've talked around but maybe not touched upon directly is the question around ESG considerations. And I just wondered how you factor those into your investment process.
Sure. Look, for us, long before ESG became the buzzword, we've integrated it as part of our due diligence, because again, the starting point for us 25 years ago was we don't invest without direct engagement. And direct engagement is what you need in order to assess your ESG risks, which were always part of the fundamental analysis. Now, if anything, E-risk has become a lot more, if you will, important over the last decade. But other than that, this was still our consideration when doing fundamental analysis. With that said, I also think we have to be realistic what emerging markets are and they aren't. It's easy for a developed European country to talk about those polluters that produce energy. But if you have 80% of your exports in energy and 80% of your revenues coming from energy, be it oil, be it coal, it's also unrealistic for us to ask emerging markets to shut down this production. Because guess what? ESG risks are not going to improve if you shut down your exports. You're much more likely to have more social unrest and governance risk related to that. So we have to be part of a solution. We cannot ask the countries to do something which we can't provide the framework for. And that's exactly what our job is. If we can work with the countries or issuers, corporate issuers, to provide funding, for example, for transition assets, that's a very big topic for us. And in fact, we think that's a very big opportunity as well. Then we can talk about improvement of ESG risks. And we are part of the solution. We shouldn't be part of the problem.
Polina, are you seeing more opportunities in private credit or any alternative debt instruments within the emerging market space? How would they compare to opportunities you would see in traditional sovereign or corporate fixed income?
Well, private credit, or I would name it more broadly, less liquid credit, is a very interesting topic. Because if you recall what I mentioned at the beginning, when you think about generating your double-digit returns, there are two ways you can do it in absolute return format. You can take a directional risk and you're buying at a discount, or you can trade the volatility, not the beta of the asset class, and generate P&L from that. Both are very interesting and very different. And actually, I would say complementary in investors' portfolio to each other. So for us, we've looked at and invested in emerging market loans for the last 25 years. But unlike developed market loans, that's not a liquid space because we didn't have a levered loan markets. Now, the good news is all those loans generally that have been originated have tight covenants, have very good security. They haven't gone through the cov-light phase that we went through with the creation of CLOs, for example, in developed markets. But the bad news is that they have no liquidity. Now, therein lies an opportunity. If you can provide the liquidity and lock up your strategies for, let's say, 5 years, then you can command illiquidity premium. So I think it's a very interesting space. I think there are very few players in the space, which makes it even more interesting. But we would definitely view it as a complementary way to generate returns with a directional bias in the corporate credit space in particular.
If you don't mind, I'd like to go back to a point you made a moment ago about how the market overall has grown over your career, but the average percentage allocation by investors has not, and is still, I think you said, in the single percentage point range. Could we just talk a little bit about your investors and their expectations for this asset class, and maybe of you and your team? And maybe the best place to start is to say sort of who are your investors and how can you share with them your perception of these strategies? And do you feel there's a lot of interest? Is it growing? Is it stalling? Where are we in that regard?
Sure. Well, look, our investors are really a very broad mix of both institutional and wholesale buyers, both in Europe and US, as well as Asia and Middle East and Latin America. We have some of the largest pension funds in the world, but we also have family offices and if you will, high net worth individuals that, again, through private banking platforms access our products. It's really, really broad. And actually, a lot of our investors have been with us for over a decade, which is reassuring. And I would say have a relatively sophisticated understanding of the asset class. Now, if I look at us as a firm, we've seen over 30% inflows in our strategies across the last couple of years. So it's been a good environment for us. But unfortunately, that cannot be said for the asset class, because if I look at the asset class data, investors have had outflows from EM fixed income over the last 3 years, which is almost unprecedented if I think back over the last 2 decades. So how do investors look at EM? I think there is a perception that EM is more volatile than developed market credit. Some of it can be true, which is in particular in the local currency, as we discussed. Some of it is not. For example, as I mentioned earlier, emerging market corporates is the index with the best Sharpe ratio than US credit, for example, and has investment grade average rating. The other misconception about the asset class is that if you invest in it, you have to have positive bias, even if you invest in absolute return strategy. And again, I think this is the wrong assumption, because as I mentioned, you can generate performance from volatility, or you can generate performance from directional risk, but you don't have to have a positive bias, which is why in our conversation with investors, we say, well, where are you on the spectrum? If you have a positive bias, but you would like it in risk control fashion, maybe we talk about unconstrained strategies, which are more total return. If you don't want to take any beta in emerging markets, but you like the volatility and you want to generate performance from that, we can offer that as well. So ultimately, there's a broad range of strategies one can tailor for the client's concerns. But I would underpin this by saying, as one of the most famous investors once said, in investing, what's comfortable is rarely profitable. And I think that the two words emerging markets in itself, scare a lot of investors, which on one hand gives us an opportunity, but on the other hand, potentially could be a missed opportunity for them. I think to conclude, I would say that one thing that Donald Trump has actually done, in my view, in my humble opinion, he erased the divide between EM and DM and actually on a global scale put it as US and the rest of the world. And so for me, it feels that overall, this is an environment where investors will look more to diversify risks away from, for example, the US, and therefore, hopefully, we'll see more interest in emerging markets.
You stole my last question. I was going to say, what is the outlook over the coming 12 months when it comes to investing in EM debt?
Well, I'd say that the outlook always starts with the themes, right, that we've talked about before. But we've talked about longer term themes like the default cycle, like the disparate monetary policies. But I think in the short term, we all have to agree that uncertainty brings volatility. And therefore, we feel that generally this is the time when you run light portfolios, because you can have a short-term volatility which can be bigger than the volatility through the course of the year. And the best way to play it is to have dry powder to take advantage of that volatility. And that's exactly how we're positioned to play this year.
Polina, this has been a hugely insightful discussion. Thank you for joining us and for sharing your expertise. And to all our listeners, thank you for tuning into The Long Short, and we look forward to speaking with you again soon. Bye for now.
Thank you. It's been a pleasure.